Welcome to Project Syndicate Algo Trading Systems Tutorials. Today we take apart the one number almost every trader trusts and almost every trader misreads: win rate. Because how often you win was never the same question as how much you make. Over the next few minutes, we'll fix that from the ground up. We'll show why win rate is the wrong axis, how a 90% system can bleed while a 40% system compounds. We'll swap dollars for R, the one honest unit that makes any two trades comparable. We'll build the expectancy table that ranks engines by edge, not by frequency. We'll multiply that edge by opportunity to get throughput, what a system actually produces. And finally, we'll run every edge through the one test most never survive: real trading costs. By the end, you won't ask how often a system wins. You'll know exactly what it pays. Let's begin. Win rate feels like the honest number, the first thing every vendor prints and every beginner optimizes. But it answers only one question: how often you're right. It says nothing about how much you make when you win, or lose when you're wrong. Those are two different axes. Watch System A. It wins 90% of the time and still bleeds 23R over 100 trades, because its wins are tiny and its losses are huge. System B wins just 40% and pays plus 40R. More wins is not more money. The number that actually compounds is expectancy. Win rate times average win minus loss rate times average loss. Positive and repeatable beats frequent and fragile. So stop asking how often a system wins. Start asking what it pays. Before you can compare two systems, you need one honest unit. And dollars aren't it. A $200 win means nothing until you know the risk behind it. Dollars drift with account size and balance, so no 2 months line up. So we anchor everything to R. 1R is simply the capital you risk on a trade. Look at the scale. A scalp risking $50 and a swing risking $5,000 both return plus 1.2R. Wildly different money, identical edge. A full loss is always minus 1R by definition. Same edge, any size. Once every result is expressed in R, a scalp and a swing sit on one axis. Position size stops flattering the numbers, and average R per trade becomes the honest headline. R is the ruler the rest of this lesson measures with. Now put R to work. Expectancy is win rate times average win, minus loss rate times average loss. Compute it for every engine, then sort by that one column. Watch what the ranking does to intuition. Row A wins 70% of the time, the highest win rate on the board, and earns just plus 0.10R, barely alive, because its losses are twice its wins. Row B wins only 40%, the lowest, and pays plus 0.60R, 6 times the edge. Row C sits in the middle at plus 0.37. The 40% engine wins, and it isn't close. The highest win rate placed last, the lowest placed first. Win rate is context. Expectancy is the verdict. Edge per trade is the only sort key that survives contact with your equity curve. Expectancy tells you the quality of one trade. It doesn't tell you what a system produces over a month. For that, you multiply by opportunity. Throughput equals expectancy times frequency. A plus 0.30R edge across 40 honest trades yields plus 12R a month. The same edge at 10 trades yields only 3. Frequency scales a real edge, and, just as fast, a negative one. So, the playbook is 4 steps. Define your edge in R. Count the honest trades it earns. Multiply for throughput, then tune both. And here's the discipline that separates operators from gamblers. Never buy frequency by loosening your entries. A tiny edge traded often can beat a big edge traded rarely, but only while the edge stays intact. Scale the edge, not the leverage. Everything so far has been gross, and gross expectancy is a hypothesis, not evidence. Every trade pays a toll: spread, commission, slippage, financing. It never sleeps, and here it's minus 0.20R. A trade. Now watch two engines meet it. The thin plus 0.10R edge flips to minus 0.10. It dies live because it was always sitting inside the noise of costs. The fat plus 0.60R edge drops to plus 0.40 and barely notices. This is why back-tested edges die. They were measured before the friction. So the rule is simple. Subtract the full cost toll, then test out of sample. An edge that survives contact is real. One that doesn't was never there, no matter how good the win rate looked. That's the tutorial today. One metric, understood properly, is worth more than 100 you half know. If it sharpened how you think, subscribe and tap the bell so the next tutorial finds you, drop a like, and tell me in the comments which topic to break down next. The operating notes and the implementation side are linked below and in Telegram. Use what's useful, ignore what isn't, and I'll see you in the next one.